staggering report shows that the average retiree lost money in their investment accounts in 2021. Why? And how can you avoid that? What should you do if that's you? I've got all that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, 2021 was, for the most part, a very smooth year in the markets. And I've told you before that, growth was very up and down, value very up and down. There were lots of volatility in different areas of the investment world last year, but the overall S&P 500 was nearly straight up and extraordinarily calm. And that was one of the reasons why we said, listen, brace yourself for volatility. We've certainly had our share of that to start this year. But last year, 2021, market was great, right? The average retiree lost money in their investments last year. Take a look at this. Even though the S&P 500 was up over 20% last year, the average retiree lost money. Take a look at this. 57% of older adults, 57% of older adults report their retirement savings were down more than 10% in 2021. That shocked me because my narrative was, okay, I see the headline, this is clickbait because bonds were actually negative in 2021. And in retirement, most retirees have more of their investments allocated to bonds, and that's why it went down, and okay, this is clickbait. Guys, this shocked me. Down more than 10%, 57% said they were down more than 10% last year. That's astounding. Another 10% of older adults indicated they suffered a decline of less than 10%. That's what I would have expected, but only 10% of older adults said that. By contrast, 16% of those surveyed said they actually had a gain of over 10%, while 6% said it was even higher than that. This is shocking to me, guys. I am surprised. Now, typically, the bond market has done fairly well, okay? So because interest rates have been going down, when interest rates go down, bond values go up. And so for the past 4 decades, bonds have not only added interest because they were paying those, but they've also added some capital appreciation because interest rates have been going down. That's the exact opposite of what happened in 2021. As well as thus far in 2022, where not only are bonds paying very little interest, if any, but interest rates in the free market, free caveat, are actually going up, and therefore bond values have been going down. And so bonds have had one of their only negative years in 2021 on record, okay, and 2022 on track for a negative year as well. But if bonds don't really explain this, what could explain this? Because certainly bonds weren't down more than 10%. And if the average retiree, the 57% of retirees were down more than 10%, that can't explain it. To me, what's got to explain it is taking too much risk, something I've been warning you about all along. It's boring to be diversified. It can be boring to be diversified. Do you own the S&P 500 that went up 20-some% last year? Yes, you do. But you only own this much of it and not this much of it. And even worse, when you look at the NASDAQ, and we believe in a diversified model and a momentum model. Our momentum model definitely had a lot in the NASDAQ, and it was challenging for that last year. If you just held growth or tech or the NASDAQ, it could have been a very challenging year for you. Let me go even further. Some of those large names in the NASDAQ were companies that did extraordinarily well coming out of the pandemic. Not just meme stocks, not just sort of trendy stocks, but ones that were well positioned when the economy shut down. Those did fantastic in 2020 and early 2021, but by late 2021 had given up most of those gains. Take a look at Zoom if you want, or Peloton if you want, something like that. Those stocks have really been beaten up. And if you are in retirement speculating on those types of companies, you got hurt. That was painful. I would also mention, and I hope your retirees aren't doing this, but last year was also the year of trading cryptos. And yeah, we saw by and large many cryptos accelerate and perform very well last year, but depending on how you were trading it, that could have been punishing to you. And also, yes, we saw some huge volatility. We've seen it a lot in these past couple of months in cryptos. And if you're in retirement, risking your retirement savings, speculating with trading cryptos, I would caution you against it. Do I like the idea of crypto investing? I do. I'm very curious about it, and at the same time, it has a risk tolerance that I would argue doesn't necessarily fit with most retirees. So you've got to be careful. If you dabble in it, that might mean some of your dollars are down or will fluctuate, but not to have 57% of all retirees say that their investment portfolio, all of their money, drop more than 10%. That's too much speculation. So now what do you do? What's the antidote? Guys, when you're in retirement or approaching retirement, you've got to have a well-defined investment strategy that will do well when the markets are doing well, but also has some protection when markets don't do well. So here's what I mean. You need to have an investment strategy that is appropriate for good times and bad, because you're going to see both, and it's impossible to predict the exact timing of when they will occur or when there will be a change from good to bad or bad to good, right? So you've got to have an investment approach that's consistent with your retirement plan, with what you need those dollars to do for you, number one. That's got to fit within your 5-factor retirement plan, okay? Second, you then need to make sure that that's consistent for when you're going to be drawing the dollars out, okay? So if your retirement plan says you should have about 60% in stock, 40% in bond, well, you then need to look and say, well, but what about the dollars that I'm going to be using over the next 2-3 years? Should those be 60-40? No, those should be lower risk. What about the dollars I'm going to be using for the next, from years 3 to 10? Yeah, those should be medium risk. Okay, those longer term dollars that have 10 years or more, those should be higher risk. When you average all that out, you should be around 60-40, okay? So that's the second thing that you need to do. And then third, in each of those areas, we call that the personal pension plan. In each of those areas, you need to have a prudent investment strategy, not one that is speculative or taking too much risk. We would argue, make sure you're staying diversified, using great high quality mutual funds, exchange traded funds that follow an appropriate recipe that's been stress tested and all of that. And then complement that, maybe with a momentum strategy, maybe with a hedge strategy. Complement that with something else so that you've got diversification in your strategies, and not all of your dollars will go down or will move in the same direction at the same time. Diversifying not just your investments, but also your strategies. Work with your CFP on that. Right now, as we see volatility, awful time, especially coming off of, if it was a bad year for you last year, you might feel this sense that you need to, now I've got to take even more risk to make up for it at exactly the worst time. Work with your CFP, who can be unemotional. They want you to make money. They want you to be happy. They want you to have a stress-free retirement, but they're more objective and can make more sound decisions and help guide you on the right path. So work with your CFP. If you don't have your CFP, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.